right now to the CIM members workshop. It's great to see we have uh, some familiar names. My name is Suki, and I will be your session moderator today. I work as an Open Innovation Coordinator for the CAREC team in ADB, and I'm very excited to be here today with you to talk about fundraising and the Singapore startup ecosystem. Most of us here are either entrepreneurs or founders or working to support the startup ecosystem, and we understand firsthand the importance of funding and resources to help grow and scale our business and startups. Also, Singapore has a vibrant and dynamic startup ecosystem, which has been recognized as one of the best in the world. So learning how this system works can provide a valuable insight and opportunities for startups in the CAREC region. So ladies and gentlemen, please allow me to introduce you to our esteemed speaker, Mr. Mustafa Rashid. He has over a decade of experience in the startup ecosystem. He's a Singaporean angel investor and startup ecosystem professional, having enabled over 3,000 startups and SMEs during his time in the public sector of Singapore. Mustafa has also worked as a venture builder in ING Bank's Innovation Lab and has designed accelerator programs for Series A startups during his time at KPMG. He's also a thought leader, sitting on the advisory board of several startups in emerging and frontier markets. Additionally, he's an avid speaker, sharing his insights on fundraising and the startup ecosystem at top business schools and organizations. So we're honored to have Mr. Mustafa today with us to share his insight and knowledge at this very important topic. Now, without further ado, please join me in welcoming Mr. Mustafa Rashid. The floor is yours, sir.
Hi, Suki. Thank you so much. And thank you for the opportunity to be here and to speak with all of you. I feel like I'm going to share some stuff, but I feel like I'm also going to learn a lot from you guys because it's people tuning in from different parts of the world, and any opportunity to share knowledge and to learn is an opportunity that I welcome anytime. If I could get you guys to just like type into the chat box real quick, just to like mention where you're tuning in from, would love to know. And I'm also going to put my slides up so that then we can kick off with the knowledge sharing. Okay, can you guys see my slides?
Yes.
Okay, so welcome to Fundraising and Accessing the Singapore Startup Ecosystem. The Singapore Startup Ecosystem is a really, really interesting and dynamic place, one which I've had the opportunity and the privilege to work in for over a decade now. And there's really a lot going on. There's a lot of different moving parts in the startup ecosystem over here. And I'm going to talk about the various different aspects of it as we go along for the next 40 to 50 minutes. And I'll tell you a little bit about myself, my journey over the last 10 years. I've spent over a decade in the startup space. It started with about 8 years in the public sector of Singapore. There's an organization called Enterprise Singapore, which has an advisory arm called the SME Center. And the SME Center is a very interesting place where basically any small business owner, any startup founder, anybody who wants to set up in Singapore can approach the SME Center and say, hey, I want to set up here. Give me some guidance, give me some consultancy on how we can do it. And everything that the SME Center does is free. So I spent about 8 years there. Every month I would engage with about 25 to 30 business owners. And I did that, for 8 years. So I met really like 2,500 businesses during that time. And I often tell people that that was the first MBA that I did, meeting with so many different business owners. And the second one was actually the one that I went to school for. So doing that for so many years, towards the end of that, I thought, okay, I'm really enjoying this, but I want to take it up a notch. So I went back to school, did an executive MBA, and I thought, okay, how do I how do I grow now in the startup ecosystem? I typically I didn't know if I wanted to be a founder. I still don't know yet. I toy with the idea sometimes, but I feel like the enabling side of it is one where I feel like I'm a lot better at. So I thought, okay, let's look at innovation labs. Let's look at corporate venture funds. And luckily, I got an opportunity from ING, which is the Dutch bank, and they had an innovation lab in Singapore where they were hiring venture builders. And the methodology was, using design thinking and things like that, looking at problem statements from different departments in the bank and trying to build ventures to address those problems. So I thought, okay, that's really cool. So I joined that. I did that for 1 year, and I learned an incredible a lot during that time. And after that, I joined KPMG for a short stint, where I was helping them build an accelerator for Series A startups. And that was pretty interesting too. So we were taking, bite-sized parts of KPMG's magic, like the advisory, tax, legal, and all sorts of different things, and putting them into an accelerator program to help ESG-related startups become global, which was really cool. I'm an active angel investor. I've advised over three, and I think now like slightly over 3,000 startups. I'm an advisor with three accelerators. I founded one angel investor group in Singapore, and I'm an advisory board member with multiple startups. And it's been an incredible learning journey. I would say that like that's probably my primary motivation for doing a lot of things. It's just that to keep learning new things. Anyways, enough about me. Well, one more. I'm going to talk about some of the organizations that I've been affiliated with over the last 10 years. Most recently, actually, had the opportunity to work with some of these organizations and these startups, either as an angel investor or as an advisory board member. PrioShop is a startup in Bangladesh, which actually works with 24,000 micro SMEs, and they have a supply system where um, small merchants can order things through an app. These 24,000 merchants order things from about 300 to 400 suppliers. So we're talking about like sugar, rice, shampoo, all sorts of staple and FMCG items. And I think their GMV right now is almost 100 million per annum. Turtle Ventures is another interesting organization in Bangladesh, which I've recently joined them as an advisory board member and will be increasing my involvement with them as a shareholder during the next couple of months. They're the first venture building studio in Bangladesh. They're going to be doing something like 6 ventures every year. That's going to be interesting. Pattern is an app from Pakistan where they're looking at loyalty points for restaurants. So the primary objective was getting footfall back into the restaurants after COVID, and I think they're doing a great job. Stuffbase is a platform where digital product creators can upload their products online and sell it to international markets. So if you're familiar with platforms like Kajabi, Gumroad, and things like that, where you could write an ebook and you could sell it online very easily. And then there's the LUMS Consultancy Group, which is the consulting arm of the Lahore University Management of Science. Homefectionary, which is a startup that they're based in Bangladesh. And what these guys do is they connect factories, warehouses, offices. They connect them to home chefs. And typically, a home chef who can produce about 30 to 40 meals in a day, they connect these home chefs to these workplaces where the workers there can enjoy meals that are typically cheaper than they would buy outside and much more nutritious and much more healthy. And it's also enabling these home chefs, which are typically women, to earn an additional $200 to $300 a month, which is fantastic. Seedify, lastly, is a Singapore-based startup, which is in the blockchain space. And what Seedify is doing is that it's bringing together VCs, LPs, angel investors, and startups onto one platform, and trying to remove any bias, of like gender, race, geographic location, and basically presenting merits of every startup to the investor in a very clean way. And I think that's really cool. Okay, so let's dive into the knowledge sharing. Some of the things that I'm going to be covering are startups, angel investors, venture capital firms, corporate venture capital, private equity, syndicates, special purpose vehicles, and multipliers. And then after that, I'm going to go into some of the best practices in fundraising, let's say if you're a startup, and some of the things to look at if you're an investor. Okay, so what's a startup? We often get asked, right? And sometimes, like if I'm trying to explain it to like my parents or my relatives or typically somebody who's in a traditional business, they're like, okay, you're in the startup space, but what does that mean? Like I hear this word thrown around a lot. So there's no clear definition of what a startup is, but I've taken the liberty to put down some points so that I think it's easier to explain to people what exactly a startup is. Typically, a startup is a micro business. Though there are startups that are really big now, like Airbnb, Uber, Grab. I mean, some would argue that these are no longer startups; these are like multi corporations now, right? But yeah, typically a startup is a micro business. In Singapore, generally it's a business which is less than 5 years old, so it's a young company. Doesn't need to be young people, but it's a young business, so it's established generally within the last 5 years. It's tech enabled, so you couldn't say. I mean, it would be hard to say that okay, I built this restaurant and it's a startup. So typically it's not like that, right? Typically it's tech enabled. It's something which is it's innovative, it's changing the way things are being done, it's disruptive, it's challenging the status quo of the way a business is being done. It's poised for high growth. So one of the key differences that I notice between startups and SMEs is that an SME owner is typically meeting their daily, monthly needs through running an SME. However, a startup founder is typically has their eye on a much larger prize. So let's say they have they're typically not meeting their daily needs from the startup in my view, but they have their sights set on like perhaps an exit much later down the road where they stand to make a lot more money. So I feel like there's a very big difference in the mindset over there. Okay, angel investors. So angel investors are typically people who provide early stage capital. They come in at the earliest stage, even in an idea stage where there's no business yet. They typically have a high risk appetite, and I consider myself as somebody who has a high risk appetite. High risk, high return. They typically look at risky, unproven ventures. And the outcome for an angel investor is typically binary. So meaning it's 0 or 1, 0 meaning you lose 100% of the money that you invested, which is what happens in majority of the cases. You typically want to pray that if you invest in 5, maybe 1 or 2 are going to do extremely well, and probably 3 of them are going to run out of steam fairly soon. But the ones that do well, I've met with people who have made angel investments and had returns of 25x, 30x. So it's not impossible, but you just need to know how to pick those ones well. And typically angel investors will they'll buy equity directly in a startup, they'll use debt, they'll use safe notes. Safe notes are now, I would say, predominantly the main way that angel investing is done in Singapore. Okay, venture capital firms. Now, venture capital firms typically invest in high growth potential startups. They won't look at very early stage. So you wouldn't, as a VC, you wouldn't look at, let's say, a seed stage or an angel seed, perhaps, but not an angel stage, I would say. They will look at startups where the ball is already rolling. Perhaps there's already some revenue coming in, and a very sizable, I would say, team by that time. Early to mid-stage startups, typically they'll buy equity. They won't buy a safe note, they'll typically buy equity. And they will make an exit perhaps in a later round, or perhaps in an acquisition, or in an IPO. I've seen that VC sometimes they'll enter at Series A, they'll exit at Series B, or they'll enter at Series B, exit at Series C, and they don't always hold on until the end. Of course, there's more money to be made, but then there's also a risk the longer you hold on. Okay. The next level in this, I would say, is private equity. So private equity typically invests in larger companies or growth stage startups. If you were to see, like, let's say, companies like Grab, companies like Uber, Food Panda, Airbnb, when it comes to like Series E, F, G, H, then that's when you see like private equity firms. And you'll also see sovereign wealth funds in this space. Like Singapore's Temasek Holdings, you'll see Abu Dhabi's sovereign wealth fund, you'll see Norway, Japan, the government money of these countries investing in these large startups. They typically invest a larger minimum amount. So usually a minimum investment in private equity is 25 million, and they'll look at Series B, Series C, Series D, and beyond. The average private equity fund is about $5 billion. And they could go up to like over 100. Like if you look at companies like BlackRock, you look at sovereign wealth funds, they can be really, really huge. But the typical size is about 5 billion. And they will hold until acquisition most of the time. Though there are private equity funds that will, sometimes they'll buy companies that have many brands and then they'll break them up and sell it into pieces, sell it like bit by bit, and they'll make more that way. I think there was a case a couple of years ago. I think it was like the Hilton Group or something. Private equity company bought a bunch of hotel brands and then sold them separately. Okay, so I've mentioned like a couple of different stages of startup funding just now. Typically, you have the pre-seed, seed, Series A, Series B, Series C, and Series D. These are generally more common. Going beyond that is a little less common because that means that they've become a very, very large company by then. And I wish we would see more of that, but it's not that common. So we illustrate it in this way where pre-seed is typically where the business is in an infancy stage, right? There's not much going on yet. It's an ideation stage. This is where the risk is the highest. And then as it grows to the seed stage, there's a little bit of a plant coming out of the ground. There's maybe one or two leaves. It's growing slowly. There's a few team members. There's a proof of concept. Then you move on to Series A, Series B, Series C, and the plant is now growing into a tree. It's becoming bigger. It's becoming stronger, and as the tree becomes bigger, the risk decreases. So the business becomes bigger, and then investors also then have less of an opportunity to buy a larger portion of that business. When the business is tiny, pre-seed and seed level, that's when an investor can say, okay, look, I'm willing to give you $20,000, but I want, 3% or 4%. But when it's in a larger stage, that 3% or 4% is probably worth, millions of dollars. Okay, so in the pre-seed level, you typically have angel investors and accelerators. You would also call this the friends and family kind of space. In the seed stage, you'd have angel investors, accelerators, family offices, and venture capital firms. Not so much venture capital firms, but occasionally, I would say. When it comes to the Series A and Series B, you would have venture capital firms, corporate venture funds, and family offices. But when you come to Series C and Series D, you also add private equity funds. This is where the numbers start to become really big. And then you'll also see sovereign wealth funds as well. Okay, so some of the top venture capital firms last year in Singapore. Number one is 500 Global. I'm sure you guys have heard of this company. It's actually not only in Singapore. It's in various parts of the world. It's in the Middle East. It's in Latin America, and they've made close to 3,000 deals, till date. And it's important to know that all these different venture capital firms have a different, I would say, like, they have a different mandate, right? So some of them would focus on SaaS companies. Some of them will focus on healthcare companies. Some of them will focus on enterprise or deep tech. So let's say if we look at the bottom of the list, Cocoon Capital, they focus on enterprise deep tech at the seed level, and their investment size is $500,000 to $1 million. So if you were a founder, it would be beneficial to know this before you go out looking for money, because you wouldn't want to go knocking on the door of a VC, which is in a completely different industry and investing in a different level of the startup that you're running. Yeah, it would just save your time and effort. Some of the other more popular ones here are, let's say, Golden Gate Ventures, Jungle Ventures, who's been around for a while. Monks Hill, Wavemaker also has a lot of investments. Very interesting company. B Capital Group, which is founded by Eduardo Severin. Yeah, a lot of interesting VCs operating here in Singapore in various different levels and industries. Okay, syndicates. Now, the syndicate is typically where you have a pool of people who put their money together. Let's say, for example, there's a startup where you have, the founder is raising perhaps $200,000. And let's say all of us want to put money into the startup, but the minimum the founder is willing to take from one person is 50,000. But each of us only have 10,000 to give. What we could do is we could form a group in the form of a syndicate. And we could say that, look, we will pool our $10,000 together. Let's say 20 of us put $10,000 each, and we have 200K. Basically, it goes in as one entity, one document where we would all invest together in that one startup. And that would happen in the form of a special purpose vehicle. So there's many organizations out there that actually arrange this kind of activity. In Singapore, you have Business Angel Network Southeast Asia. You have Angel Central, Angels List, a global website, which is a very, very good example. They form syndicates and special purpose vehicles all the time. Basically, it enables people to come in at a much smaller check size into startups that they may not have the access to otherwise. And I think it's a great thing. I think Pakistan has a few, Bangladesh has a few, India has many, China I think has a few as well. So yeah, these are really, really interesting. These are typically private groups. They're, sometimes you need to be a member, sometimes you don't. And the good thing is that there's no one individual has control. These are typically consensus-driven groups. So like, let's say if the group invests at the seed level in a startup, everybody in the group basically has to agree that everybody has to exit at one time from that startup. And majority has to agree that whether they want to make that exit or not make that exit. And I'll talk about the mechanism a little bit in the next slide. Yeah, so the mechanism is the special purpose vehicle. And basically how this works is, this is a business entity made for a specific purpose of making an investment. It can be a private limited entity, and it's for a specific time period. So let's say the group of us decide to invest in a startup, and we decide that, okay, we want to hold on to it for 2 years or 3 years or 4 years. We would then make that investment and then exit at a later time. And at that time, when we decide to make that exit, the SPV will then be dissolved, and the investors will be paid back their principal amount plus the earnings. And there are many companies out there that can facilitate this now in Singapore and in many other countries. In fact, it's slowly becoming a way for aspiring venture capital fund managers to sort of take a dip into the space of like managing investors and managing documents, because I think it's kind of like a way of like learning how to manage LPs and learning how to manage the investment process. Okay, venture building. Venture building is an activity that I've had the opportunity to take part in when I was working in ING Bank. Venture building can be done in a couple of different ways. The way that I was involved in it was in-house venture building. And it's also known by the name of intrapreneurship, where companies basically hire some external people and some internal people from various different departments. And they'll put them together in one team, and then they'll give them different problem statements to work on. So we had problem statements that we were working on from logistics, from aviation, from shipping, from land, from commodity trading. And then additionally, being a bank, we also looked at different problem statements from the Monetary Authority of Singapore, which they would publish every year, that they would invite industry to come and address these problem statements. So I would say that it's an interesting way to look at entrepreneurship. It's a slightly more academic way to look at it. There's a low risk appetite because these are big companies typically. So their appetite to take big risks and to risk their brand name is quite low. So it's very different from, let's say, a grassroots startup that you would find in an incubator or accelerator or in a co-working space. Because the kind of entrepreneurs that I was used to meeting and that I was exposed to prior to that was, you thought about it in the morning and by afternoon you already start, right? But how it works in corporate venture building is that typically there's many layers of approvals. There's many stakeholders to work with before things can move. So this is typically the in-house way of doing it. There's an external way of doing it where there's companies like BCG, there's companies like McKinsey, there's companies like Rainmaking and Mach 49. The Economic Development Board of Singapore has actually approved 4 or 5 different companies that they will co-fund part of the venture building activities, where if a corporation in Singapore engages one of these companies, then the Economic Development Board will subsidize part of that activity because they want to encourage more venture building activities to take place in corporations in Singapore. Yeah, so the external way, how it typically works is these external parties will partner with corporations. For example, like PNG, for example, various different large corporations, and the external party will do. They'll help identify what those pain points are in the business, and they will provide the expertise. They'll provide the venture builders to help build out those particular pain points into ventures that the business can run and spin off and generate revenue from their clients. So in my opinion is that it's best done externally, because if you were to look internally, like even as a human being, if I were to look at myself and say, I can look in the mirror all day and I won't be able to identify my shortcomings. But if I were to ask somebody else who's an expert to say, hey, Mustafa, I think you can improve on these things. To me, that looks like a more productive approach to it. But yeah, there's many companies doing it in these 2 different ways typically. This is typically what the venture building process looks like. There's idea generation, there's concept validation, there's venture launch, and there's scaling. So this is taken from the Economic Development Board of Singapore's website. So yeah, this is typically how it works. When moving from like idea generation to like concept validation and then to venture launch, it's like there's many like each process has like sort of like an internal pitch to like different stakeholders in the organization. Okay, multipliers in the startup ecosystem. So this is an area, I would say, this is my favorite part of the startup ecosystem. And over the last 10 years, I've spent, I would say, like most of my time with these elements in the startup ecosystem. So accelerators, incubators, entrepreneur communities, angel investor groups, co-working spaces, innovation labs, and university innovation hubs. These are like, I would say, any like entrepreneur, any like, let's say, aspiring entrepreneur who wants to get into the startup space, I'll always tell them, go and spend time in these places. Go to attend events and accelerators, go and meet entrepreneur communities, listen to pitches at angel investor groups. go and sit in a co-working space, spend a few weeks over there, go and talk to different startup founders. And the amount that you can learn is incredible. And yeah, and I'm glad to see that there's many of these coming up in different parts of the world. Um, yeah, and it's just a very great way to boost the startup space. Some of the very well-known ones in Singapore, and you guys might know some of these. Accelerating Asia is very, very popular. Over the last 4 or 5 years, these guys have done an incredible job, and they've attracted a lot of applications from Pakistan, from Bangladesh, from Southeast Asia, even as far as Africa and Latin America. So I think they're really good. Antler has done phenomenally well. They've opened branches all over the world. I don't know how many branches they have now, but so many. It's a great accelerator. F10 has recently rebranded. I can't remember what the new name is, but F10 is an accelerator, an incubator that looks at fintech startups. Very, very interesting organization. 500, I'm sure you guys know. Iterative is becoming really, really big now. Plug and Play is also very, very well known. Plug and Play looks at fintech, insurtech, ESG, and a couple of different areas. So yeah, if you guys are ever in Singapore, I would highly encourage you guys to visit these organizations. I see a question. Feel free to jump in.
So I think the question is specifically, what are the sectors or industries of current appetites of Singapore ventures? It would vary, but if you can shed some light, what are the trends like right now?
Sure. Thanks. There's a lot of emphasis on like machine learning, AI, artificial intelligence and stuff like that. I would say these are like the buzzwords these days, but the startups that are really bringing the returns, I would say, are the ones that are focusing on larger markets like Indonesia, Philippines, Vietnam, um, places like that. And venture capital firms will in Singapore, they really like to see startups that are focusing on solving problems in these big markets. I meet a lot of startup founders in Singapore that are trying to solve problems for Singapore. I tell them, look, Singapore is a great test bed, but it's a small market where about 5 million people only. Though it's a bit of a premium market, but it's like there's no mass adoption to be had here. The mass adoption is to be had in really the big countries. And venture capital firms will put money on these bets very easily. If you're doing supply chain stuff, if you're doing BNPL kind of stuff in these big markets, these are things that they find really, really attractive. The tech space, which is like, artificial intelligence, machine learning and stuff like that, these are good, but these are typically longer plays. And the play is a bit more binary in the sense that like, it may work out really well, or it may crash altogether. Whereas in the space where you're solving problems for like micro SMEs and stuff like that, that's, I would say, a little less of a binary outcome in these markets. So yeah, that's my view. I hope I answered the question. So I'll move on to the next slide. Okay. Yeah. So cryptocurrencies. So the market is a little bit quiet on cryptocurrencies these days, but I feel like this list wouldn't be complete if I didn't mention it. It's had an incredible run, I would say, over the last decade. Stable coins, base coins, altcoins, meme coins, exchanges, wallets. If you ask me, like the most active space has been exchanges and wallets, and these guys have made some incredible utility, for users, for businesses. My sister used to work in a fintech startup that was providing, payment services for high risk merchants, and I thought that was really, really interesting. But yeah, your stable coins, base coins like your Bitcoin and Ethereum, I feel like they're going to be around for a long time. let's say the use case or the validity of these, there's still an open debate about it, right? And personally, I'm a little bit on the fence about whether the market is going to make a comeback. Funny enough, the last 1 or 2 days, I've been watching the cryptocurrency market, and some of the cryptocurrencies that I've invested in have been having an uptick of like 20-30% after being like dead for like 1 or 2 years. So it's really strange in this space where like I don't really know what the economic factors are that affect the space. So yeah, I would say it's still an open book, and I think we probably have another 1 or 2 more cycles in the cryptocurrency space before we see real like utility for people like you and me to be using it on a daily basis. Okay, so this is like the second part of my presentation now, where I'm going to be talking about some of the best practices, if you're pitching to investors. So when you talk to an angel investor, and let's say if the investor says no, accept it, but always ask for feedback. And what happens many times is that startups will approach an investor a couple of times, and the investor, and I've done this before too, like sometimes I'll just ghost the startup because I'll feel bad about saying no, right? We often feel bad about saying no. I think it's human nature. So I would encourage founders to reach out to the investor and say, look, it's okay if you're not keen, but I'd really love to get your feedback because I appreciate your knowledge, your market, your background, and I'd love to tap into your knowledge. And it's fine if you don't want to invest, but I would really appreciate your feedback. Every coffee meeting or call is an opportunity to ask for introductions. So anytime you meet with someone, you meet with an investor who you think they're not going to invest in your startup, or you feel like you don't want to take their money for some reason, always ask for introductions. Ask for people. Warm introductions are really, really good, right? So if you can get that person to introduce you to more people, I would say that is a successful meeting already. Avoid giving away equity. Use safe notes. So I can't tell you how important this is. In the last 1 year, I've met some startup founders who are, really enthusiastic, really bright, but sometimes they come into a crunch where, they really need money to see the next month of the business. And then an opportunist will come along who will say that, okay, we'll give you 20,000, we'll give you 50,000, but we want 30%, 40%. The investor might think that they're getting a very good deal, but actually you're killing the business, because if you're taking that much equity, the opportunity for that startup to go and raise money from big investors is very limited. When a venture capital fund sees that you've given 30-40% to an early stage investor, it becomes highly uninvestable. So I would say avoid giving away equity in an early stage. Use safe notes. Safe notes are basically, they function like a loan, and the money invested by the investor converts into equity at a later date. So yeah, that's something really important. Identify strategic advisors and advisory board members. This is really a really good, I would say, a really good practice for many startups. Have a strong advisory board where you have individuals who have a background generally in your industry, where they can open doors for you, they can make introductions for you, they can give you advice. And I'm an advisory board member in many startups, so I know sometimes I have to play the role of devil's advocate. I have to play the role of sometimes as a counselor, sometimes I have to play the role as I have to give tough love sometimes too. So it's quite interesting to be an advisory board member, and I would say that the benefit also for the startup is also very good. You have to incentivize advisory board members. Typically, it's a very, very small stake of equity. So typically between 1, 2, 3%. I would say avoid giving away anything above 5%, keep it definitely below that. Anything 10% or above is already in co-founder territory, so stay way below that if you're giving equity to advisory board members. Typically, how I structure my advisory board deals is that either 1 year, 2 year, or 3 year vesting period, and either I'll structure it as a straight equity or I'll structure it as an option. Sometimes for tax reasons, it's better to structure it as an option, because if you're given equity directly in a startup for providing service or providing work for them, then it's considered that you worked for them and you were compensated with equity, so that can be taxable. So I know that sounds a little bit complicated, but if you have any questions, I'm really happy to. I'm a bit of a nerd for this kind of stuff, so feel free to ask me if you have questions about it. Okay, don't ask investors to sign NDAs. They'll probably ghost you. So this is something I would say that I've been asked a few times to sign an NDA, and most investors and advisors and stuff, they typically won't do it. The secret sauce is not. It's not in your pitch deck. It's not in your idea. The secret sauce is in your execution, right? And your execution comes from your experience, your knowledge. So I could take your pitch deck, but I won't be able to replicate the business the same way you intend to do it. Yeah. Co-founders, I would say, try not to like interrupt each other when you're pitching to an investor. Try not to be like rude or talk over each other. Try to be very pleasant and be very confident, but not arrogant. Okay, so I'm going to talk now a little bit about how to go about identifying angel investors. In the Singapore context, typically, when you meet people in an event, in a networking setting, have a one-liner, because generally everything is really fast here. So let's say if you wanted to tell a story about your background and about how you ended up in this business, generally like people won't have the time. They won't have the interest and they won't have the time. So have a one-liner like, hi, I'm Mustafa, and I'm the founder of X. We're looking to help startups get the right funding and the right tools and hacks in order to raise money from the best investors fast. So this tells the story immediately, very, very quickly. Also prepare like what's your ask. So we're raising 250,000 at a 3 million valuation, and I'd be happy to share more if you like. Then you gauge the interest, from the person who you're talking to, that is that something that they want to know more about. Otherwise, don't waste your time. Put them together, and then you have a bit of an elevator pitch, right? Where everything comes together nicely. Like, hi, I'm Mustafa, and I'm the founder of X. We're looking to solve for gaps in early stage startup funding by equipping founders with the right knowledge and hacks to raise funds fast. We're looking to raise 250,000 from strategic angels, and I'd be happy to share more if you like. So this tells the whole story very, very quickly, very to the point. And the person you're talking to can quickly make an assessment that, okay, is this something that I want to know more about? So if you want to use this format, feel free to go ahead and plug in your own details, and yeah. The next part about identifying angel investors is, so you can find angel investors generally in incubators, accelerators, co-working spaces, innovation labs, events, conferences, cold outreach, and syndicates. You will find that they gravitate to these places, but the downside is that investors in these places will be bombarded with deals. There'll be a lot of startups in these spaces. So you'll really have to try, you'll have to try extra hard, really hard, to stand out from these investors. So I find that for me as an investor, and when I reach out to other investors for the startups that I'm involved in, I find that this particular way, which I'm going to show you now, is probably the most productive way and has the best result. Do a LinkedIn search for angel investor, mentor, board advisor, venture partner, limited partner. These are people who already know the startup space very well. And they're already advisors, they're angel investors, they're already involved in the space in some capacity or the other. So they don't need to be educated about how the investment process works. how a startup works and all that. They know the process. Um, don't ask for money immediately. Ask for advice. And I can't stress this enough because I get a lot of startups adding me on LinkedIn. The moment I accept, there'll be a really long message and a pitch deck attached. So I think that startups think that they're doing, their quantity is good. They call it like spray and pray, right? So just send it out to as many people as you can and pray that somebody responds. I would say people generally don't respond to messages like that, right? Like even when we were earlier in our career, we'll send our CV like that to people, right? We'll just send it out randomly. I would suggest that do something like this: connect with someone and then say, "Hi, Mustafa, great to connect. I noticed from your profile that you've been in the startup ecosystem for over a decade. I'd love to get your feedback on my pitch and business model. Can I buy you a coffee sometime or connect over a call?" I would say something like this is an instant yes. Whether it's you're approaching somebody who's in the fintech space in a bank, somebody who's in the FMCG space, somebody who's in the chemical space, or whatever it might be, as long as you show interest in, that you appreciate their background, you want to tap onto their knowledge and their expertise, and you feel like they will add value in your journey, it's not just about the money, I would say the response will be much, much better. Okay, some of the best practices for pitch decks. The 10-20-30 rule. I would say this is really, really good. I think it was originated by, I think Guy Kawasaki, if I'm not wrong. And the 10-20-30 rule is basically not more than 10 slides. I think personally up to 15, I think is okay. Not more than 20 minutes to present, and font size not smaller than 30. So you want it to be a presentation and not a document. And like when I worked in management consulting in KPMG, I saw that there was a lot of like a presentation deck was made like a document. There's so much of details crammed into like one slide, which is, it's okay if you're sending a proposal, but it's not okay if you're making a presentation. You want the viewer to be listening to you and not necessarily trying to read all the words on your slides. You want their attention to be focused on your voice and on your face. Yeah, use less words in your slides. Yeah, that's how you keep their attention on what you're saying. Okay, if you are an angel investor, some of the things that I've learned the hard way is that founders' personalities, right? These are really, really important. What is the founder like? Are they able to take feedback? Are they coachable? Do they take a data-driven approach? I've seen founders where you can be passionate about a particular subject, which is very good. But if the numbers are telling you something else, then you have to listen to the numbers, right? Because numbers have no bias, right? If you're running some experiments, you're running an MVP, the numbers will tell you the right direction to go in. So a founder who's mature enough to understand that is a good one. Registration domicile. Now, there's incredible startups, in frontier and emerging markets and all over the world. But sometimes, because of like policies or because of barriers, it becomes hard for an investor to invest in these markets directly and repatriate money back to where they are. So I will always encourage startup founders to have a offshore registration in a place like Dubai, Singapore, Hong Kong, Delaware. This will immediately increase the investability of your startup. Some of the best founders I've met have been Singapore registered actually from day one, though they're running startups in Pakistan, Bangladesh, Sri Lanka, India, all over the world. But when it comes to raising money, investors will be a lot more confident to put the money in a Singapore company. Yeah. Next is valuation cap. When you're looking at startups and you're evaluating them, take a close look at what the valuation cap is at the time when you're investing in the startup. A good starting point is, if your accelerators will look at 1 to 2 million, but generally a good starting point is, 2 million, 3 million, anything below 5 million. If a startup has a starting point of a 10 million valuation, I would say it's not impossible, but they would be doing, hopefully they would be doing something really interesting and really, really cutting edge. Valuation matrix. Valuation matrix is like looking at what logic is the founder using. Excuse me. What logic is the founder using to get to that valuation? Is it based on the market size, based on the opportunity? Is it based on some revenue that they've already made, a multiple of that? What is the logic? And I would say there's no right way. It's just that does the founder have that mindset to be able to justify it? Valuation journey. So valuation journey is more like a projection, right? You can't hold the founder accountable for the valuation journey that they present. But let's say if I invest at a startup at a 6 million valuation today, I want the founder to be able to articulate to me that, okay, at the end of this year, we want to be at a 25 million valuation, or we want to be at a 30 million valuation. At the end of next year, we want to be at a 50 million valuation. And how are we going to get to that journey? So how are we going to get to that point? So this is something really important for founders to know in order to convince angel investors, because angel investors, typically we're not so passionate about the industry or anything like that. We want the return, right? So we might like the space, but we want to see the return. And this is one of the things that articulates how that return is going to come. Then there's market size. Market size, what is the opportunity? So let's say your market is 20 million people. How many people are going to buy, or how many people are in the profile of the customer that you're looking at? What percentage of those do you think are going to buy it? How much is that revenue going to be? So market size, typically there's a couple of, how do you say, like it starts with a bigger number, then it moves down to like a medium-sized number, then it moves down to like a much smaller number. Total addressable market, we call it. Yeah. So, and then the last one is the exit opportunity. So one of the things that I often ask founders is that what's the exit opportunity like? So is it, if I invest as an angel investor at an early stage, I may not hold it all the way to an acquisition. Perhaps I want an exit opportunity at a Series A or Series B, that when a venture capital fund comes in, I will want them to buy my shares. Or if there's an acquisition, perhaps I'll sell it at that point. If there's an IPO, I would love for that to happen, but that would be a long way from the time an angel investor comes in, maybe 5 or 6 or 7 years even. So these are some things that I would want the startup to think about on behalf of the angel investor, that as an investor, we foresee that your exit will be at this point, at this value. And again, this is a projection. You cannot hold the founder responsible for that, because everything is predicted by market forces. So yeah. Okay, some career lessons that I've learned along the way, and this is just for fun. It's okay to walk away from a deal, and I've done this many times. We often feel afraid that, like, if I walk away from a deal, then perhaps I won't get another opportunity, but it's not true. Opportunities will continue coming, and there's a certain strength in saying no to something, which is a sort of a muscle that we have to grow over time. We're often afraid to say no to things, but it's okay. Every coffee meeting counts, like I mentioned earlier. So always take the opportunity to network and to meet new people and to ask for introductions. Yeah, warm introductions are magic. Build a strong network, engage with people, learn about them, learn from their life lessons. LinkedIn is a great place to do that. I spend a lot of time on LinkedIn. I've been posting a lot, growing my followers over there, and I learned an incredible lot from people who follow me. So, yeah, have a quick personal pitch. Be flexible about how This is something that we learn as we get older, right? Be flexible about how you might be passionate and you have some goals in your life, and you could get to those goals, but how that happens will definitely change along the way. Because we typically don't choose how that happens, right? So it's it unfolds the way it unfolds. So keep an open mind. Salary is not everything. And lastly, don't be afraid. I can give an example about fear. When I was very young when I first started in my role in the public sector, I was giving a presentation to a room of 25 business executives. And it was a conference room, like a long table, and I was standing at the end of it with a projector and giving a presentation. And I was really nervous, like my hands were sweating and I was shaking, and it was a short presentation, maybe like 15 minutes. And I remember, like, when I was done with that, I was so relieved, and I was like, thank God that's done. I never want to do that again. And then, even the coffee tasted better after that, because I wasn't because it was already done, it was over. So, but then slowly, over time, I kept forcing myself, so 25 people, 30 people, 50 people, 100 people, 200 people. And then a couple of years ago, I hosted an event for 1,000 people, where one of the trade minister of Singapore attended that event. And by that time, after exposing myself so much and leaning into that fear of public speaking, I became very comfortable. And it was really something I started to enjoy. It was something that gave me energy to do things like that. So yeah, don't be afraid. And actually, that's it from me. I'm really happy to take any questions. And I hope you guys have enjoyed my presentation today, and I hope you found it informative.
Thank you very much, Mustafa. We already have a few open questions waiting for you.
Sure.
Yeah.
Let's take a look.
Yeah, there was actually a first question that was moved to the answered panel. So I'm going to read that question it was from Atif, saying that I'm in process of moving headquarters of my startup from Delaware to Singapore. Please address the startup incorporation process and Singapore tax structure.
Okay. So corporate tax in Singapore is about 17% per annum. If you're a startup, and let's say it depends if you're generating revenue, and is your revenue generating in the Singapore company, or is the revenue generating in the Delaware company, or is there another market beyond the Delaware company? But yeah, 17% is the corporate tax. There's a lot of tax reliefs in Singapore, like so many of them. And most businesses don't pay very much tax, I would say, in Singapore. The highest taxpayers are the corporations, and though SMEs are the biggest employer, the corporations, I would say, pay the highest amount of tax. Incorporation process is quite simple and quite straightforward. Incorporating a business in Singapore is easy, but the harder part is getting a visa if you want to live here. That's when it gets a little bit more complicated. You need to engage a corporate secretarial firm that will do the registration for you. Typically, you would spend between 3,000 to 5,000 US dollars, I would say, in the incorporation process. I've seen startups, typically they'll register a Singapore headquarter company, which will then own the company in their other market. So the Singapore company will then own the Pakistan company, or it will own the Bangladesh company, or whichever market it is, to the full extent that it's allowed in foreign ownership. And fundraising will take place entirely in the Singapore company. The share distribution, everything will happen in the Singapore company. Acquisition will happen in the Singapore company. Yeah, typically that's how it looks like. The process will take, to set up in Singapore, it will probably take maybe like a week. The bank account also takes another couple of weeks. But if you were to approach, let's say, a digital bank or a service online, something like Aspire, that's a lot faster versus approaching a traditional bank like DBS or UOB. Those guys will take much longer to set up a bank account. So yeah, very happy to engage on this subject. Drop me a line on LinkedIn, and happy to set up a call. And like I mentioned, I'm a bit of a nerd for these kind of things, so feel free to drop me a line. I hope I answered the question adequately.
Yeah, and let's also move on to Wu Bak Hor's question. Where do accelerators have financial resources to finance startups? Are these private and public accelerators? What about accelerators based on public organizations?
Okay, so there's accelerators in public sector and in the private sector. The public sector accelerators in Singapore, they get their money from, I would include even universities in public sector. So, they will get their money from the government, obviously, and then they will work together with some corporations sometimes to, let's say the corporation will give some problem statements to the university and say that, okay, we will work together with the university and we would like to invite the university students to address these problems. So come and pitch startups to us that are addressing these problems. So that's one way I would say that the government will do it. Monetary Authority of Singapore will also run some, competitions for problem statements. They'll work together with Google, with KPMG and companies like that. In the private sector, I would say it's a little bit different. So you have private accelerators. Typically, some of them will have a venture capital fund together with it, and they'll go and raise money from LPs, like really like one by one, they'll go and close, 50,000, 100,000 from different LPs. And then they'll use that money to invest in these startups, in these accelerator programs. Another way that they do it is that they partner with corporations to run accelerator programs for them. Or they'll have corporate partners who will continue to fund them. I think even companies like Microsoft and AWS will also support accelerator programs. I don't know how much cash they give, but they do support in a lot of things like, credits and stuff like that. So yeah, for the private sector, generally they'll have their own VC and then they'll raise money from private investors. In the public sector, they'll get money from the government usually. So whether it's universities, research centers and stuff like that.
Yeah, as we're running out of time, we're taking one last question from Harry's But it's a long question, but I think I'll read it for everyone. Given the challenges and risks associated with investing in emerging and frontier markets, including issues related to political instability, regulatory framework, and currency fluctuations, how do you ensure that startups seeking funds are adequately prepared to navigate these challenges and mitigate risks? And what steps do you take to minimize potential negative impacts on the broader ecosystem and society as a whole?
Sounds like you're talking about Pakistan. So, so the common way has generally been to use an offshore registration. So like I was mentioning earlier, Dubai, Singapore, Hong Kong, Delaware. I made one investment in a startup in Pakistan last year, Pattern, and these guys were a Singapore company from day one. And thankfully, these guys, they had been in the startup ecosystem for many years before with big startups, so they knew exactly how the regulatory framework works. They knew how to register a Singapore company, link it to the local company in Pakistan. They knew exactly how that works, how to set up a bank account overseas, how does all of that typically work. So I would say that it definitely increases the scalability and growth of your business if you have that element in the overseas market where your startup is registered for fundraising. When it comes to fundraising and anything to do with shares and all that, as a global standard, it's all done in US dollars. So the currency risk over there is a bit less. The currency risk is more in the market where the business is operating, right? So if your business is being done in PKR, then of course the currency risk is a bit higher, but hopefully the market prices and inflation and everything goes together with the business that you're doing, right? So eventually you also have to raise your prices and everything to keep up and be able to make that return also eventually, to increase the value of the business. So yeah, I would say that there are investors that do invest in these higher risk spaces, right? There are some really enthusiastic investors that look at Bangladesh, Pakistan, and other frontier markets. One of them is Sturgeon Capital, right, which is based in the UK, and they're very enthusiastic on frontier and emerging markets. So I would say that, like, though the risk is higher, there are investors out there that have a higher risk appetite. So it's just how you mitigate that risk. Ideally, you want to address the risk head on and not beat around the bush. Address the risk that yes, there is a currency risk in our market. Yes, there is political instability in our market, but this is how we're mitigating that risk by doing these XYZ things. Regardless, we feel that there is a huge opportunity in our market.
Yeah, thank you very much. So thank you everyone for staying with us. We apologize for running 10 minutes late, and thank you, Mustafa, really for sharing your insight and expertise.
No worries. I just saw one question from Atif, which is key terms for advisors options. Look up a document online called FAST Agreement. FAST Agreement is the advisors agreement written by the Founders Institute. You can find it online. It's 100% free. You just have to plug in the details. Yeah, sorry, please go ahead.
Yeah, I'm sure Atif can get in touch if you have any further questions. So Mustafa has kindly shared his contact and LinkedIn information here. And thank you, everyone. We hope you found this workshop informative and valuable. We will be posting the slides and the recording on the web page. My colleague will share the link later by email. Yeah, so thank you very much, everyone. And if you have any questions, please feel free to contact us. Thank you, and we hope you have a great day. With that, I would like to conclude the session. Thank you very much.
Thank you, everyone. It's been a pleasure. Thanks for the opportunity.
Thank you, everyone. See you.